Hey guys, welcome back. Now, recently I did a video on Ray Dalio's top 5 ETFs. Link above and below if you want to see that. This video is all about Ray Dalio's top 5 individual stocks. As Ray Dalio is one of the world's top investors, it's always good to keep an eye on where he's putting his own money. Now, Ray Dalio did buy quite a lot of individual stocks right now, but I'm not going to include the smaller positions that you might have seen on other videos. This video is going to focus on his 5 largest positions. I do think these are much more valuable to know, and it's also where Ray Dalio is most bullish. Now, it's important to note that Ray Dalio's largest positions were normally ETFs, as he is a big fan of diversification. So it was really interesting to see that his company, Bridgewater Associates, was taking big positions in individual companies. 3 of the 5 companies are brand new positions, and the other 2 he has increased his holdings on. So this video is up to date as from the end of 2020, and stick around to the end of the video because I'll also include a recent interview he's done where he gives some advice for investors in the current climate. And what he said about bonds is quite surprising, considering his famous all-weather portfolio was largely made up of bonds. As always, if you do find anything in this video useful, be sure to drop a like. That would be much appreciated, as every like does help. Okay, sit back and relax, guys. Here are Ray Dalio's top 5 stocks. So, Ray Dalio's top 5 stocks. Here we go. Coming in at number 5, everybody's favorite beverage, Coca-Cola. So this is a brand new position for the company, and he's put in around about 100 million. So this is the 5-year chart, and as a snapshot, the company is worth about 228 billion. It's a great dividend company, Coca-Cola, over 3%, much higher than average. Their year-to-date performance hasn't been great. In fact, of the 5 companies, this was the only one that was negative for the year. And longer, so it's 5-year on average, also hasn't done that well. Only 5% a year. So not a massive growth company right now. And you can see the effect of the pandemic this year. The company did take a massive hit. Let's take a look at their financials. So this is the revenue and profits of the last 4 years. So what can we see from this? Well, there's a bit of a concerning trend line when it comes to revenue. So look at 2016, 17, and 18, the trend was going down, falling revenues. And looking at the profit for 2017, this must have been a major concern. However, since then, the trend line for the profit has been going up, so maybe the tides have changed. Coming in at number 4, we have JD.com. So looking at this, you might think, what on earth is JD.com? So this is a big e-commerce company in China. Now, this actually isn't a brand new position. Bridgewater did already hold this position, but what they did do was increase it by 20%. So this is now their 4th largest holding, and they currently have around about 130 million invested into this e-commerce company. At a snapshot, it's a pretty big company. It's valued at $133 billion. It doesn't pay a dividend. Its year-to-date performance has been brilliant, growing at 125%. So similar to like Amazon here, with the pandemic, the e-commerce giant has done really well. And its 5-year performance is excellent. So it's returned on average 33% a year, way above the market average. Looking at their financials, we can see an excellent trend for revenue. Look how steep that curve is. So revenue is looking great. A bigger concern is the profit. So it's actually had 3 years of negative profit, which isn't great. However, in 2019, we can see it has broke into profitability. So I assume that Bridgewater has seen the trend on the revenue, and this is now going to be a big profitable company. Okay, coming in at number 3, a brand new position, and this is P&G, Procter & Gamble. So you'll probably notice lots of these, so lots of big famous brands under P&G. We've got Pringles, we've got Oral-B, Head & Shoulders, Duracell, Gillette. So lots of mega brands come under P&G. So this was a brand new position for the company, and they invested around about 170 million. It's a really big company, market cap 346 billion. It is a strong dividend payer, so 2.27, so it does pay a good dividend. Its year-to-date performance is 13%, so slightly above market average. So it has done well, all things considered, this year. And its 5-year performance, again, above market average, returning 17% on average per year. Looking at the financials, so the trend line for revenue over the last 4 years is up, so that's looking really strong. But its profit trend was going down for 3 years, 17, 18, 19, and 2019 looking pretty worrying. Since then, the trend has switched and is now going up. And you can see in 2020 so far, that's pretty good. So around about 70 billion in revenue and over 10 billion in profit. So I think they're betting that P&G will keep going over the next 5 years. Coming in second place, we have Walmart, America's most famous success story. So ticker symbol WMT, and again, this is a brand new position for the company, and they invested around about 200 million. So a big bet on Walmart. It's a really big company, 431 billion. A dividend player, but it's lower than average. Its dividend is 1.45. Year-to-date performance has been excellent. So growing almost 30% this year, double the market average. And its 5-year performance is excellent as well. In fact, it's been growing on average 30% a year for the last 5 years. And I think this has to do with its focus on becoming online e-commerce, potentially a big competitor to Amazon. And I think Bridgewater has seen this and taken a large position in Walmart. Financials, let's take a look. So the trend line for revenue is going up, and you can see this is now over $500 billion in sales. The profit trend again was going down for 3 years. However, it seems to have turned and is now increasing. But what really strikes me from these financials is just how much revenue they make in comparison to their profit. So their profit margins are tiny. So we can see 2020 so far, they've done over $500 billion in sales, yet they're only doing about 15 billion in profit. So their profit margin is only 3%. And this will be the same for a lot of e-commerce companies that focus on the lowest prices. Their profit margins are really, really small. And coming in then in first place, number 1, Alibaba Group. So you might just think that this is Alibaba.com, but no, Alibaba Group has actually bought a lot of companies over the years. So Alibaba Group is all of these businesses. So we've got Alibaba.com, obviously. Youku is actually the China's version of YouTube. So a huge video site. We've got a few e-commerce companies. You've got Alibaba Cloud. So it covers a huge range of businesses. So they did already hold Alibaba. However, you can see in this last couple of months, there was a big drop. And I'll come to that in a second. But now they've bumped up their position 40% and they own almost 400 million. Market cap this is a huge company, 685 billion. It's not a dividend payer. Their year-to-date performance has been great, growing 18%, but their 5-year performance is awesome. So on average, it's been returning 45% a year. So if you are going to put most of your money into one company, this is the one that you want. And obviously, this has made a lot of money for Bridgewater. So you can see there was a recent drop. So what was going to happen is that Alibaba was going to do the biggest IPO in history. However, the Chinese government has postponed it about 6 months. So the share price did drop. And that's why Bridgewater increased their holdings by 40% to take advantage. Now, check this out, their financials. How about that for a trend line in revenue? So they've been skyrocketing their revenue over the last 4 years, a great trend line. But unlike all the other companies that we just saw, look at the trend line in profit. They've also been rocketing up in their profit. And unlike Walmart, where they've only got a 3% profit margin, this year they did $500 billion in sales. However, they did 150 billion in profit. So that's a 30% profit margin. So if you want to own a business, this is the one you want. And for a quick bonus on this video, here is a recent interview Ray Dalio did.
How does Bridgewater adapt to the new world order that you've been thinking about for a long time, I should add? Anybody who is familiar with your writing and your speaking knows that.
There's a period of, I think, great uncertainty and great risk. And so I think there are 3 words: diversification, liquidity, and then differentiation. Every individual, every company, every country they're good. How well they are depends on how much their income is relative to their expenses and how much their assets are relative to their liabilities. So you can see radical differences in the financial consequences of that. Second, the proximity to those who are printing and distributing money. Are you a recipient of that? For example, a lot of the third world is not a recipient of that and is not in good financial situations. And then there's order, political and also social order. So and you could see it differentiated in the countries that are controlling the virus and behaving orderly and well together. So you could see those differentiations reflected in the market's behavior, and you can also see it reflected in the political and social conditions.
Well, we know that markets are discounting mechanisms, Ray. I don't need to tell you interest rates at zero, but I'll remind everybody that stocks keep rising to new records, and not just here in the United States, but globally. PE ratios haven't been this high since the dot-com era. The dollar, to your point about currencies, Ray, has slumped to a 2.5-year low. Do asset prices and valuations make sense?
You know, when we look at interest rate markets, we look at the earnings yield. When we look at stocks and we look at PEs, they're basically yields. And the capacity of central banks to print money and buy financial assets has essentially led the bond market to go to multiples that are somewhere between 100 times. You know, you put a dollar out and you'll get your money back in 100 years. It's because of the nature of, so it's as a 100-time multiple. You have to compare stock multiples to bond multiples. And so the capacity of central banks to put liquidity into the system and to have that liquidity go to produce high multiples is very real. In my opinion, don't own bonds and don't own cash, because they're producing a lot of debt and producing a lot of money to fund it. And so that's changing the nature of capital flows. It's also changing how those flows go to China in terms of the comparison of that market, particularly as it opens up. So I think it's behaving sensibly, but don't use old multiples as reflections of the limitations of what's expensive.
So there you are, guys. Those were Ray Dalio's top 5 largest individual stock positions. So what can we take away from this? Well, like I mentioned, historically, he always chose the big ETFs as he's a big fan of diversification. So it was really interesting to see these big, large individual positions pop up. There was Coca-Cola, Walmart, and Procter & Gamble were brand new positions. Did you notice there was quite a lot of focus on e-commerce? And his biggest bet so far is on Alibaba. I did do the full Ray Dalio portfolio. If you want to see that, links above and below. Okay, just one favor to ask. If you did find anything in this video useful, be sure to drop a like. That would be much appreciated, as every like does help. If you haven't yet subscribed to the channel, be sure to click below and join us. I do have some great videos coming up that you don't want to miss. If you still have any questions or comments, just post them below. Okay, cheers guys. Thanks for watching, and I'll see you in the next video. Bye for now.